The dot-com crash. The dot-com bubble, also known as the internet bubble, grew out of a mixture of presence of theoretical or Fed-based investing, plenty of venture capital funding of startups, and the failure of dot-coms to turn a profit. Investors put money into internet startups during the 1990s, hoping they would one day become profitable. Many investors and venture capitalists abandoned a restrained approach for fear of not being able to cash in on the growing use of the internet. With capital markets throwing money at the internet sector, startups were in a race to quickly get successful. Companies without any copyrights technology abandoned financial responsibility. They spent a fortune on marketing to establish brands that would set them apart from the competition. Some startups spent as much as 90% of their budget on advertising. Record amounts of capital started flowing into the NASDAQ in 1997.
It doesn't make any difference to us. All we're interested in is what the business is worth. And what people are paying attention to in terms of capital flows or whatever, or market signals.
By 1999, 39% of all venture capital investments were going to internet companies. That year, most of the 457 initial public offerings were related to internet companies, followed by 91 in the first quarter of 2000 alone. The high mark was the AOL-Time Warner mega merger in January 2000, which became the biggest merger failure in history.
It's exactly 10 years to the day, January 10th, 1990, when Time Warner was formed. So in fact, Time Warner is not old media. AOL is in fact older than Time Warner.
Fed Chairman Alan Greenspan warned the markets about their illogical enthusiasm on December 5th, 1996. But he did not tighten monetary policy until the spring of 2000 after banks and brokerages used the excess liquidity the Fed created in advance of the Y2K bug to fund internet stocks. Having poured gasoline on the fire, Greenspan had no choice but to burst the bubble. The bubble ultimately burst, leaving many investors facing steep losses and several internet companies going bust. Companies that famously survived the bubble include Amazon, eBay, and Priceline.
From 1997 to March 2000, prices went up about 5 times, only to go down 5 times and return to their pre-boom levels from 2000.
The bubble that formed over the next 5 years was fed by cheap currency, easy investment, markets pride, and pure gossip. Entrepreneurs concerned to find the next big score freely invested in a company with a .com after its name. Valuations were based on earnings and profits that would not occur for several years if the business model actually worked, and investors were all too willing to overlook traditional basics.
Even discussing the issue. The Federal Reserve is a very professional outfit. They know more about how the economy...
Companies that had yet to generate revenue, profits, and in some cases a finished product went to market with IPOs that saw their stock prices triple in one day, creating a nourishing passion for investors. The NASDAQ index peaked on March 10, 2000 at 5048, nearly double over the prior year. Several of the leading high-tech companies, such as Dell and Cisco, placed huge sell orders on their stocks when the market peaked, igniting panic selling among investors. Within a few weeks, the stock market lost 10% of its value. As investment capital began to dry up, so did the essence of cash-based .com companies.
It's the moment investors around the world wait for, the 9:30 opening of the U.S. markets.
.com companies that reached market capitalizations in the hundreds of millions of dollars became worthless in a matter of months. By the end of 2001, a majority of publicly traded .com companies closed, and trillions of dollars of investment capital was wasted. The .com bubble burst when capital began to dry up. In the years following the bubble, record low interest rates, the adoption of the internet, and interest in technology companies allowed capital to flow freely, especially to startup companies that had no track record of success. Valuations rose and the money eventually dried up. This is what led the companies to crash, many of which didn't even have a business plan or product. The dot-com crash was triggered by the rise and fall of technology stocks. The growth of the internet created a buzz among investors, who were quick to pour money into startup companies. These companies were able to raise enough money to go public without a business plan, product, or track record of profits. These companies quickly ran through their cash, which caused them to shut down. If you like this video about the dot-com catastrophe that happened in the 2000s, then hit the like button and subscribe to our channel to stay up to date and get more informative videos.